Hello and welcome to Homeowner Talk. My name is David Stone and I'm the president of Nevada Association Services. And this is my co-host, John Leach, who's a partner in the law firm of Leach, Johnson, Song, and Gruco. Each episode we'll be here to talk with you about important homeowner topics. Whether they involve homeowner association issues or homeowner maintenance problems, we, along with our guests, are here to provide you with useful information on these subjects.
We also want to encourage you, our viewers, to interact with us and our guests each episode. So please visit our website at homeownertalktv.com and send us your questions, and we will try to answer as many of your questions as we can on the air and online. On this particular show, we're going to be speaking about banking and lending matters for homeowners associations, and we have with us today Craig Huntington of Alliance Association Financial Services. And Craig, we really appreciate you being with us. You've been with us before, but I don't know if it could be any more timely today than talking about banking and lending issues. So thanks for joining us.
It's great to be here, John. There has been a lot of turmoil in the banking industry the last couple of years.
Well, tell our viewers first a little bit about yourself, how you got into the banking industry.
Well, I own a management company actually in Southern California, and after being there about 20 years, I decided it was time to move on. So I came to Nevada and hooked up with a small bank in Nevada and started this little HOA program. And we banked maybe 5 or 6 management companies and a couple hundred homeowners associations. That bank really wasn't in tune to what we wanted to do, so I joined Bank of Nevada, First National Bank of Nevada, and the program grew to be a national program in 10 years.
And I understand that now with the bank you're working with now, Bank of Nevada, or a division of Bank of Nevada, is you have a division that actually specializes or works closely with homeowners associations.
That is correct. Homeowners associations are a very different animal to a typical banker. Most people walk into a bank and open up an account for themselves or for their corporation, where a management company has to walk into a bank and open up an account for this other entity that they aren't signers on, they're not on the board of directors. So it's a very different animal, and there's a few banks in the country that specialize in this animal we call homeowners association, and we're one of them.
And specializing, I think, is the key right there. You have to have a banker that kind of understands the uniqueness of homeowners associations.
That absolutely, for sure, David. It is very difficult for a typical banker to understand homeowners association. I'm lucky being in the business for 20 years. In the management business, I know what the managers and what the homeowners associations want.
You're coming at it from a very unique perspective because you've really been on both sides of the equation.
I even tell people I'm not a banker, I'm just a property manager that works at a bank.
Well said.
Perfect.
Maybe before we jump into the HOA nuances and issues, maybe you can just give our viewers a little bit of an overview or the current status of the banking environment. Are there funds out there with all we've heard about bailouts and whatnot? Maybe you can just give them a little insight of maybe the current status of things.
Well, it is pretty tough out there for the banks to do business, John. There have been a lot of bailouts, as you know about. Our particular bank, Bank of Nevada, which we're a division of, Alliance Association Financial Services is a division of Bank of Nevada. We're a pretty strong bank. We've had some tough quarters on the profitability side, but we're very well capitalized. We're making loans, we're making a lot of loans, but the loans are tougher and tougher to make now with capital declining. People are having a difficult time, with their homes. They don't have the equity in their homes. They don't have the equity in their businesses that they used to. So it's just harder and harder for the banks to make the loans, but they're still being made out there.
So was Alliance in any way involved in the bailout programs or system that was going on?
Well, Bank of Nevada did take some TARP money back when taking TARP money was pretty much a good thing. They were giving it to the good banks. And so the Bank of Nevada did get $170 million in TARP funds. But we're using that to make loans, which is what the program was all about. A lot of banks are just paying it back, so they're not under the thumb of the government anymore, as a lot of people think they are. But we're using it to make loans, which is what I think Nevada needs and Las Vegas needs.
Craig, there was a headline in the paper a couple days ago. President Obama is urging banks to make loans. Can you talk about that for just a minute or two? What are they doing now in order to get the funds out there into the economy to make those loans? Securing those loans, banks just don't give loans with a signature and that's it. They're expecting that money to be paid back and they want to guarantee it in some way. So maybe you can comment on those couple aspects.
Yeah, well, you're right, David. The banks, I think, especially our bank, we want to help the economy grow, especially Las Vegas and Nevada. But at the same time, we got in trouble because we were making loans to entities and people that couldn't pay them back. We had huge increases in land value and property value here in Las Vegas and Southern Nevada, and all that has gone away. So it's much tougher to collateralize a loan now than it was 2 years ago. And everybody's much more gun shy than they were 2 years ago, and they don't want to get back in the same place we are. So the banks are making loans, but you just have to be a pretty solid individual or corporation to get that loan.
And I know before you came today, you prepared some graphics, and I'd like to put the first one up on the screen, and maybe so our viewers can see this. You identified some of the things you might look at as when associations might be borrowing money. Could you maybe outline some of this for us?
Well, yeah, sure, John. Associations need to borrow money from time to time to do some of these things like capital improvements, if they happen to be in a construction defect litigation and they need to make repairs right now, or they need to pay attorney fees. So banks that specialize in this industry can make loans to homeowners associations. They're very unique and very difficult for a typical banker, again, to make. And the two things they don't have is nobody personal guarantees the loan. If both you and David own your own companies, and if you went in to borrow money, you'd have to personally guarantee that loan for your company. Well, homeowners association, I don't know of anybody that's going to guarantee a homeowners association loan.
There go our board of directors.
Yes, if I'm on the board, I'm not going to guarantee this loan. And the second thing is a bank always looks for a secondary source of repayment. If you go borrow money for a car, the bank says, okay, from your income, from the money you make in your salary, you can pay the car back. If you don't pay it back, we can take the car. So they have two forms of repayment of that loan. Homeowners Association only has one form of repayment. You don't take the pool or the front gate.
That's a good thing.
Yeah, exactly.
People like to swim.
Yeah, so it's difficult to make those loans, but if you understand them, the loans can be made. The main thing the bank will look at is accounts receivable, which is a difficult thing right now. A lot of people are behind in their homeowners association dues and assessments, and that's the first thing the bank looks at. They want to know that you're collecting your assessments to be able to repay back the loan.
So is there a threshold, a percentage of homeowners that might be delinquent that puts you where you're maybe not able to get a loan? Or what about the fact that many of these associations have adopted collection policies, and at least what they're out there trying to do is collect that revenue, and they're going through the means they can. Plus, as you're familiar with, is many times banks are actually foreclosing on units that they've loaned money on, and now they're paying associations at least some of the money. Does any of that factor into the decision to loan money to an HOA?
Well, and that's exactly why we can loan money to HOAs, John, because there's always somebody going to pick up the slack at the end. Not always, but 99 times out of 100. If a homeowner doesn't pay their dues, they're usually not paying, or their assessment, they're usually not paying their mortgage. Then the bank takes over, and the bank will pick up the assessment. But the bank making the loan to the association still has to see that they're going to get paid in a timely manner when they loan the money to an association. So typically it's 10%. The bank wants to see 8 to 10%, less than 8 to 10% in delinquencies in an association. And they always want to see a strong collection policy. That's very important. That's where David's company, we work with him a lot to look and make sure they have a good, strong collection policy and they're going after delinquent homeowners. Very important.
And they're really depending on the income from the assessment. That's how they pay their bill every month when they get the bills from you. So I mean, that is so important. That's in essence how they're paying back the loan to you, and the banks do expect to get paid back.
Usually, David.
Right.